and welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake, Humboldt, and Ankeny, Iowa. Today, we're going to be discussing one of the number one reasons why retirees seem to really struggle in having enough money. And it's not something that they are doing today, although I suppose it could be. More often than not, problems start earlier than that. And today we're going to be discussing a type of an account that if you have this, you absolutely must listen. It's going to be absolutely vital to you to hear what type of an account seems to hold so many people back. Now, if you're brand new to this podcast, I would just want to say welcome to the program. If you've been looking for a place that's down to earth, that's very straightforward, no frills, nothing fancy, no real, technical jargon, something that's plain English, well, this is the program for you. And boy, do we have the background to back it. If you go to our website, johnsonwim.com, there is an absolute archive of information, whether it's YouTube videos that we've posted every single week, could be white papers. It's a number of different radio shows that you can listen to. These are all things that we want to provide you so that you can have every opportunity of success in retirement. It's not the things that we know that hurt us. I think we can all be agreed at that. It's the things that we don't know. And so if you've been curious about a particular topic, if you just simply happen to be a blank chalkboard, you don't feel as though you know anything, well, this is a safe and non-threatening place that you can come and that you can become educated on financial topics that are relevant to you. Now, back to our topic, what could this one type of an account be that seems to be so dangerous to people? Well, it's right underneath your own nose. It's something called the Dormant Retirement Account. You see, dormant retirement accounts are something that I think most every human being knows that they should probably be doing something with this type of an account, but it's kind of one of those things. It's out of sight, it's out of mind. Sometimes it's kind of inconvenient to work with it. Sometimes you don't know necessarily where to go. You have to take quite a bit of effort sometimes to work with it. But what exactly is a dormant account? Well, a dormant account is a prior retirement account that you were contributing to, that you were actively participating in, but now you are no longer doing that. Maybe you've had a separation of service from that employer because you chose to quit. Maybe you got fired. Maybe you got laid off. Maybe you just simply retired from that position. Well, either which way, when you have a 401k, when you have a 403b, when you have a 457 plan, or any number of other types of accounts like simple IRAs or SEP IRAs, these are accounts that you are precluded from depositing more money into. In other words, you've had that separation of service, and that employer is no longer paying you. You're no longer getting a paycheck from them, which means that you no longer can defer money out of a paycheck into that account. And so even if you pick up the phone and you call Vanguard or you call Principal or Merrill Lynch and you go, hey, I'd like to add money into this account, the answer is going to be a very simple no. No, you cannot. Now, so if this is a dormant account and I can't add to it, is there any other thing that's really a problem? Because you're probably thinking, I've moved on, Matthew. I've got a new job. I've got a new 401k. I don't care to add to that old account. I'm now participating in the new one. But wait a minute, not so fast, because you see, it's the things that we don't know that hurt us, remember? Well, what we need to do is we need to think about the entirety of this dormant account. Number one, if you are no longer contributing to this account, that means you are no longer dollar cost averaging. Now, there's a bit of a technical term, although it's much simpler than what you might think. So what is dollar cost averaging? Dollar cost averaging is something that absolutely works to your benefit. If you're not doing it, you absolutely need to be doing it. And if you're participating in a 401k or a 403b, you're deferring part of your paycheck into that account, then not to worry, you are at least doing some dollar cost averaging. But what about this dormant account? Well, because you can't add any more money to it, and you're not adding more money to it, you're missing out on this this mathematical magic. Say that 10 times. Now, I'm going to have you do an exercise. Let's pretend that you have $100. Grab a sheet of paper and a pen and write down $100. Let's say that you pick up the phone, you call the custodian that this account is with, and you say, hey, I want to add $100 into this account. And let's just pretend, even though we know you can't, let's pretend that they allow you to add money to this account. And let's say that they say, you know what, a really good fund for you to add money to is the ABC fund. And today, those shares are worth $10 a share. I'd like you to write down 100 times $10. Now, if you're able to buy shares in this ABC fund with your $100 at $10 a share, how many shares can you buy? If the answer is 10, you would be absolutely correct. And you're probably thinking, well, why would it be a multiple? Just hang with me here. You'll see the math. So I'd like you to put 100 times 10 equals 10, and then put shares behind that. Now, let's say that a month from now, you have another $100, and you've decided that you want to go ahead and add some more money. And so you pick up the phone, you call this institution, and you say, hey, I've got another $100. And they say, well, today, the shares are worth $5 a share. So in the next line on your little piece of paper there, you're going to put $100 times $5 equals how many shares? And if you said 20, you're good at math. So 20. Now let's just stop there. That's all the further we need to go. I'd like you to draw a line underneath your 100 and 100. How many dollars have you invested so far into this ABC fund? Your answer should be very simple math, 200. Now I'd like you to go to the opposite end of this formula where you have the 10 and then you have the 20. Put a line underneath that and let's add those numbers up. How many shares do you now own of that ABC fund? And the answer should be, again, very simple math, 30. Now I'd like you to take and put a line underneath your number of dollars paid per share. It's right in the center. You bought some of these shares at $10 a share. You bought some of these shares at $5 a share. Now, let's just see where we're at here. We've so far invested $200. So far, we own 30 shares. Now, here's the tricky question. What is the average share price that you paid? Now, just think about it for just a moment. You might be inclined to write down $7.50. And you know what? It would make total sense. You know that number's got to be somewhere between 10 and 5. So $7.50 is where most people's mind goes. However, the real answer is $6.66. Man, it's very interesting math. The average share price that you paid was $6.66. Why is that? Well, the reason is very simple. When the price was high, you bought very few shares, and when the price was low, you bought quite a few more. In fact, you bought twice as many. Now, we can get into retirement and reverse dollar cost averaging. We're not going to complicate this podcast with that math. What we're just simply going to discuss is the fact that, you see, this is a mathematical magic that you're missing out on simply because that account is dormant. It's dormant. You're not adding any more money to it. Your employer is no longer matching and adding money to that account. You're no longer buying shares. Now, granted, you're probably focusing on the next new account that you have, maybe the new 401k with the new employer, maybe the 401k or the 403b with that new employer. But this account is sitting over here. It's doing absolutely nothing. You're missing out on the math. So that's a reason that we need to consider we're missing out on that. So what would we do with that account? Well, the idea is that if that account is dormant, if it's no longer attached to that employer because you're no longer attached to the employer, then you need to roll that account from where it's at into an IRA, into an individual retirement account. And why is that important? Well, from a number of standpoints. Number one, Let me ask you about this dormant 401k. Do you know how much in expenses you're paying? Are you telling me that I have expenses? Well, let me ask you a question. Do you know the phrase, there ain't no free lunch? And I'm sure that you do, right? It's very common in today's society. We know that if we have our money somewhere with an institution, that there always is a cost. Now, granted, there are institutions like banks and the government and even some insurance companies that will take our money and not charge us anything for it, and we get a return on our money. But remember, folks, my friend, remember, this is something where that institution, whether it's the government or the bank, they're making money on your money while your money is with them. That is your cost. That is an opportunity cost to you. So I digress. Moving that 401k, that 403b, from the old place to the new place, meaning the individual retirement account, is totally tax-free. It doesn't cost you any taxes if it's done correctly. Number two, it's going to likely afford you the opportunity of being able to bring your expenses down. Because remember, even though 401ks and 403bs are touted to be extremely inexpensive, and by and large, there are many of them out there that are inexpensive, they are not expense-free. There's always fees. There is always costs. And I've seen employees who didn't even realize that they were paying the custodian, in this case, Fidelity or Vanguard or any number of other institutions and custodians, a management fee every single month. They didn't even realize it. Now, for most people, that's probably not the case, but who knows unless you look into it. And here's the deal. Moving from that 401k to that IRA would allow you to get rid of that expense. Number three, we have to realize that this opens up a universe of options for you. You see, when you go from an employer plan to a traditional IRA, an individual IRA, now you are not constrained to what that employer had for investment options in that 401k or that 403b. You see, remember, employers need to keep their life simple. They need to be able to cater to the masses. So as a result, when you look at the various different options that you had or have as an employee when investing and contributing money into that 401k, well, they're going to keep that list pretty small. And what this means is it could be mismatched with your tolerance. You may find that all of the things that they give you as options to invest your money in within that 401k, old or new, is extremely risky. And maybe you're risk adverse. Maybe you're close to retirement. There just really isn't anything in that 401k that is speaking to you. It is resonating with you because, well, quite honestly, you look at it and the list is risky. Well, my friends, this is where we have an answer. If we move that old employer account into an individual account, well, now we get to allow ourselves the opportunity of investing the way that we want. We can invest more appropriately for the age that we are, the stage of life that we're in. We get to be able to find and focus on the things that are going to make us feel the best or prepare us the most for what that next stage of life is going to be. In other words, if you're only a few years away from retirement, do you really want to focus on risk and growth when in reality you know that you could get shrinkage, you could get loss? Maybe the answer is going more conservative, focusing more on fixed income instruments that are going to pay you that 5 and 6 and maybe even 7% every single year. Maybe that is what you want just before retirement. Well, again, if you have that dormant account, you can do that. You can roll it tax-free from that individual employer account to an individual retirement account, an IRA, and you'll be able to now have an entire universe of options that are open for you. Now, this third and I would say most important topic, or I guess detail, is the one that we really started with. So we're circling back to the beginning. Dollar cost averaging, how important is it? It's vital. It is vital that we have the opportunity of being able to continue to invest. But again, You might be wondering, how can I do that? This is an individual retirement account. Matthew, I know that if I add money into this account, if I'm not itemizing my taxes, I'm not getting a deduction for it. But you're missing the point. Let's tie point number 2 with point number 3. Remember just a moment ago I said we can take a dormant account from an employer and we can roll it into a traditional IRA, and that allows us the opportunity of being able to invest any way we want. Now, here's where this matters to you. You see, if you're investing more appropriately, if you're investing individual types of positions, things that are going to create a known return for you, meaning interest and dividends, let's say that it's producing, 6% on average. Well, guess what? Those dividend dollars that are being paid to you in that individual account, that new account that you've opened and that you've moved your money into, now as those dividends get paid to you, as that interest gets paid to you, month after month after month after month, and do I dare say it again? Per month. This is something that now affords you the opportunity of continuing to dollar cost average. It allows you to continue to buy. Now, is it something that's going to be as much money coming in per month as it was when you were working? I don't know. Depending upon the size of your account, my friends, it could be even more than what you were contributing to your account when you were working for that employer and participating in this employer plan. But you see, I don't want you to miss the forest for the trees. Dollar cost averaging and continuing to dollar cost average, even if you are in the stages of retirement, are absolutely important. Being able to have an excess in interest and dividends and continuing to buy shares every single month, my friends, that is magical. It is something that allows you the opportunity, regardless of whether the market is high or the market is going through a period of tumult where it's going down. This gives you an opportunity of being able to dollar cost average those dividends and those purchases. And this just only adds to the number of acres that you have on your farm. And remember, the more acres you have, the more rent you get to spend, right? So may I encourage you, look for those dormant accounts. I don't care how big, I don't care how small, but if you have dormant accounts from leftover employer relationships, this is something that is really going to set you on the fast track to be able to consolidate your money, make it more purposeful, get a sense of direction for it, and get that principal, that money, working for you in a way that, gosh, if you need the income, well, you've got the interest, you got the dividends, you can spend those with reckless abandon because that's just not even touching your principal. That's the byproduct of how you're investing. And if you don't need the interest and dividends, well, you can continue to reinvest it, bringing more value to the table by buying more shares. And that's only going to grow the number of acres that you have, make your farm bigger, and hopefully be a bigger legacy to your spouse and to your children and to your grandchildren. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.